So to start off, some things that we all can agree upon with crop insurance. So number one, does the farm bill matter? Yes, yeah, I see some head shaking. Thank you for the crowd participation, I appreciate that. So yes, the farm bill does matter, right? We had a continuation of the farm bill, so nothing new is out there, although we will see some new things coming up with the farm bill, I believe. Not sure what that'll look like. The farm bill is what dictates your safety net from FSA, the ARC and PLC decision that we've had recently, but then also crop insurance is governed through the farm bill as well. We always keep track of what those new amendments coming are. There's always some naysayers out there that want to get rid of crop insurance completely, or that want to cut subsidy levels, or anything along those lines. And so it's important to keep track of what that farm bill is doing. One thing that we've seen an amendment out there for the farm bill would be looking at ARC PLC decisions, or maybe an increased subsidy for SCO and ECO. Some different interesting ideas that come out of the farm bill discussion. So we'll see what that looks like as it goes forward. And I've got a couple slides in here about what maybe we're looking for the farm bill from a cost standpoint. Past performance. What's past performance usually indicative of? Future behavior. Have we heard that saying, right? So past performance is indicative of future behavior. That is the case sometimes, and sometimes it's not too. So I've got a couple slides and things to visit about there. We'll look at the 24 crop in our presentation. Some program reminders and some gleanings that we always look at through the last year of us traveling around. Any surprises? Maybe from this presentation, maybe there's some good discussion today. We'd love to have that discussion, so any surprises there would be good. But then also surprises for what this year's going to bring. When we were out here last year at this time, what were the conditions like out here in Southwest Kansas last year? Terrible, right? Things were pretty bleak. We weren't too excited about what was going to be happening for the future year. And then what happened? It rained. And it rained and it rained, and it kept raining, right? So we had a once-in-a-lifetime recovery and really got a lot of this area removed from the drought in a very short amount of time. I don't know if people have seen that in their entire life. So that's exciting to see where we're at today. Things are different from where we are today than where we were last year. That being said, some of the strategies that we looked at last year implementing with producers that we work with still worked. And there's a lot of reasons why that happened. So we'll take a peek at what those were and why they look like. And then also premiums. Good news on crop insurance, your premium bill is going to be about 15% less than last year.
Right.
So that's exciting, right? Yeah. Why would that be? Price. So not only is premium down 15%, but also your coverage is probably going to be down off of that 15% too. So good. Got a great informed crowd. I thought I'd start with that good note of premiums being down, so appreciate that. So another thing that we can all agree upon, sometimes we are willing to pay for somebody else to take on some of our risk, right? So that's the whole idea of insurance, no matter what type of insurance it is, whether you're insuring some property or whether you're insuring your crops. So sometimes we are willing to pay somebody to take on some of our risk. The more allocated risk that we want to cede off and get off of our plate and give to an insurance company, usually the more you're going to spend, right? And so the more coverage you purchase, the more it's going to cost you. And whether that's a higher deductible, whether that's a lower deductible, is all indicative of that. The idea is that we want to reduce the highs and lows and hopefully stabilize your on-farm ROI. And so we want your revenue to be stabilized over the long term. Purchasing decisions, not only for crop insurance reasons, but all of your inputs going into your crop are going to differ, not only for you, but for your neighbor. They're going to differ depending on what county you're in, maybe, depending on what the crop conditions look like. And so purchasing decisions aren't always just yes, this is good for everybody. A one-size-fits-all approach for crop insurance is really difficult to get to. And so looking at that individually is important. And so we always say it depends. And likely there's probably a joke there with depends on. So looking at crop insurance and past performance is indicative of future behavior at times, but there are things out there. So stocks, the stock market, some things change, right? Not always indicative. Sports teams, K-State tips off here in about 20 minutes, and so what's going to happen with that? You know, past performance might be indicative of future behavior. Maybe Tang gets another technical today. Maybe the officials are a little better, I don't know, than the last game, so we'll see what that looks like. And then marriages. You know, if you ask my wife, am I gonna act the way I did when I come home this afternoon that I did when I left? Probably so. I'm probably still gonna be a pain in her butt at times. So past performance might be indicative of future behavior there too. Prices and weather forecasts. We try to give our best guess on what that looks like. And so Bledsoe's going to be here this afternoon and looking forward to that presentation. But with federally subsidized and federally regulated crop insurance, those do act differently at times. There's still outliers, right? There's still things that can happen, like a once-in-a-lifetime rain event that really improved yields in our outlook from last year. However, with that being federally subsidized and federally regulated, the data that we can look at historically can show us how things will work, right? And it gives us a good idea of what things look like. And we look at that data and dive into it to see if we can find what the trends are there. Rules and regulations and all the different programs that are out there are all part of that data set. So speaking of weather, one thing that we always look at is the drought monitor. This is pretty current, so map released on the 18th of January. You can see here where we're sitting today. We are no drought, and that is a lot different map than what it was a year ago this time, right? And so that's a good deal. We do still have some dry weather there in central Kansas, but overall the drought remains and is improving right here through the central Kansas area. We like to use some really big info graphics on our slides at times, and so we've got two very cute smiley face or frown face here. What do you think the smiley face is for? That we're out of the drought, right? That things look better, right? What do you think, yes, and what do you think the other smiley face is for? Or why the other? Another reason why the smiley face is there. Because there's drought here, right? Oftentimes when there's drought there, that really helps us with price support. When we are the outlier and we're in a drought and the majority of the Corn Belt is not, that's usually not a great thing for us, right? And so seeing some of that is okay too. ERP, who all has filled out their application for ERP 22? Got it into FSA. You guys got paid already too? Have you guys got payments back? Good. So ERP, it got pulled forward for the 22 crop year again. However, it paid a lot differently than the previous two. The first ERP was awesome. You used crop insurance data. Things worked pretty well. Your application was pre-filled. You turned it in, and it paid well. I mean, there are some real dollars that were moving out of FSA for ERP. Phase 2 ERP was a little different. You had to qualify with a drop in income. We found anomalies out there that people qualified because maybe they bought something in a year and then next year they didn't. Maybe they had their crop insurance check, didn't get paid until the following calendar year, and so that qualified them for a qualifying loss for ERP Phase 2. This one's a little different. Application was simple. However, the dollars aren't quite there either with ERP 22, right? So the dollars are a lot different than what we expected from the previous two. So allocation of funds are difficult right now. So whatever the amount is that was listed on your ERP application, roughly came around about 10% is what that came to, depending on what that total dollar was for ERP 22. However, if you were a beginning farmer, a veteran farmer, a minority farmer, or a woman farmer, then that paid your premiums. And so you were reimbursed for your premiums with that. If you had the CCC 860 form signed a year ago. And that's kind of difficult to go back and sign that a year ago, right? So we had some offices that were willing to help out with that, some offices that really weren't, but it just depends. So that is a big deal though. Paying a portion of your premium for the 22 ERP could amount to maybe doubling your payment. And so big deals there. One thing that we've seen a lot of our producers do, if they're a sole proprietorship, maybe they've formed a joint venture with their spouse, and then they farm 50-50 with their spouse, right? And what that's done over the last 3 ERP payments is that that has increased their overall payment from ERP. And so looking at that is an opportunity for you to be able to capture more of those dollars. If you have a corporation or an LLC, if the entity is at least 50% female owned and operated, then there's additional benefits from the ERP programs that have been paid out. So if I were you, I would ask about that CCC 860 form, if you fall into that group, to see if you do have that on file in case there's future ERP payments out there. That way you qualify for those and then that additional payment there. With ERP 22, if you do receive any ERP money, then you are required, and when you sign that form, you're required to purchase crop insurance for the next 3 years. So you're going to be required to have a crop insurance policy in place if you have an insurable interest through 2026. So make sure of that and try to remember that in 3 years.
Yeah, to clarify, it's 2 years. You didn't sign it till now, so they couldn't require you to have your wheat insured this year when it was past the time to do that. So it really goes 25 and 26 is what's going to be required. So it is 2 years, but just plan on through 26. It really comes into play with the landowner, right? You have a landowner who has just a few acres of something. They say, why are you going to insure that? We're not going to insure their third of an 80. It's not worth messing with. Well, if they have to pay back their ERP payment, it is big, okay? And so then the cost of that insurance, which may be 30 bucks an acre on this, they can sustain that risk. You do not want to ask them for money back from them. So keep that in your brain as you make those decisions.
Yep. All right, looking at the Farm Bill. The next Farm Bill that we're going to pass is going to likely be the first $1 trillion Farm Bill with a T, with a TR in front. Those are big numbers. When we looked at the 2018 Farm Bill, we had under $900 billion in there. Crop insurance accounted for 78, roughly, $1 billion there. So that was 9% of the overall Farm Bill that crop insurance was a part of. Throw in the commodity programs, ARC PLC, another 7%. So the things that we look at daily accounted for about 16% of the overall Farm Bill in 2018. Looking forward, everything's gotten bigger, everything's gotten more expensive, but crop insurance, we also went up. Instead of 78 billion over the life of the Farm Bill, 101 billion, and then commodity programs 68. So both of those numbers increased, however the percentage of the pie went down too. So of course, as everybody knows, the majority of the Farm Bill is the nutrition bill, the SNAP program, right? So should we decouple from that? Should we try to pull the farm out of the nutrition? I see somebody shaking their head and back. No, absolutely not. Reason being that if we were to pull anything out, we would not have any political support across the nation, right? So we've got to have votes. And unfortunately, less and less people live in rural America, and more congressional seats are held in the higher populated areas. So we have to have that tie there. We also have to try to do a lot of education. This is one of the first farm bills where we have so many freshman members in Congress. And so the education opportunities are extreme to try to get people to understand what crop insurance is, how it works, and how it affects their constituents is incredibly difficult. However, it can be done. I've been to DC and I've done some lobbying on behalf of the crop insurance industry, and it's rather interesting to sit down with somebody from Florida and explain how that affects their blueberry farmers in the state of Florida. All the while making sure that we are trying to keep a viable program out here. So tons of work to be done there, and we'll see what the Farm Bill comes up with. However, since the last 2018 Farm Bill, what's happened to your inputs on farm? Gone up. I mean, everything is more expensive, right? And so a 55% increase in fertilizer, 59% increase in fertilizer, livestock feed 55%, fuel 40% increase. So our margins are getting tighter and tighter on farm, and it's becoming more and more difficult to consistently make money on farm too. So these are things that we are trying to get out in front of our congressional staffers. That way they make sure they have the information to help us make informed decisions when it comes time to negotiate the future Farm Bill. All right, any questions so far? We've inserted some subliminal messages in here. One of them is these huge words, turning claims timely. It's always important when you have a crop insurance policy to make sure you turn that claim in timely. much easier to get a withdrawal signed by an adjuster than to try to turn a claim in now. So always make sure of that.
Okay, hey, thanks. I'm Justin Schrog, house over in Central Kansas. Started our firm back in 2015, had a few years in the banking industry before that, and so tried to bring some of this ROI decisions I was looking at in the bank with my customers to try and keep them farming through the future, whatever that looked like for their farm, and through transition back to this industry. And I think that sometimes we miss out on some of those things, so we're going to try and highlight them for you. So we tried to find smaller fonts, we couldn't, and so we had to go with this. I know it's hard to see, but what we will do is if you give an email, if you want a card afterwards, if you talk to Brian or someone else you know, find someone who you think might be able to contact us, we will send the presentation, and then you can see all of the tiny fonts and everything that I know it's impossible to see back there. But there's a lot of information and a short amount of time, so we'll go for it. So we look at the Farm Bill and say, well, how important is it, and why in the world are these guys with crop insurance talking about Farm Bill and Arkin PLC? And it's because there's a direct tie that can lead to a huge difference in stabilizing your income and then giving you a higher return on your farm than what maybe some of your neighbors are that aren't looking at all of the different aspects. But the first thing to look at is, what does our base look like, and how does that influence us? And so that base came from sometime well before me. We had a chance to update base. We can't create it. It's this mystery numbers that then FSA gets to kick out a payment from. But what we do know about the base is we can see how the program acres are averaged out there. And so in Kansas here, we have 21% corn, we have wheat at 50%, soybeans at 13%, and then milo at 16%, and minor base on down there, all right? I'm from Central Kansas and farm on the Harvey-McPherson County line. I updated to the max. So back in 14 was the first chance I could change the base from what I inherited from my dad and grandpa, where it was wheat and milo. Guess what? I did whatever I could. You know how much base I have that's not wheat and milo now? Oh yeah, I'm up to a whopping 15%, right? Because we weren't planting anything other than wheat and milo in the previous years from 7 to 13 when we got to update our base, all right? And then we got another chance to update our base and update payment yields and look at that stuff in 18, right? Can I change much? Well, we just had to look at the previous 4 years, and we had to look at, was I growing good crops there? Do I control whether I grow good crops there? So you see some difficulties, but anyway, that's the makeup. I can go west, and I have farmers that plant no corn, and their base is 87% wheat, and it will be the balance in milo. Okay, I come to my area, I am planting at times less than 15% of my farm is wheat, and I am corn and beans for the most part, and I have no base. All right, so when we look at our safety net, it's really important to know what are our base acres, what are we planting today, and then what other programs are out there to try and help give us support. So again, I've got Kansas, Brian said there's Kansas, Oklahoma, Colorado, Texas would be a few people, New Mexico, but I went and looked up what is the base made up of, and then I said, okay, what are we planting today? And so I go and look and say, what are we planting? And we see that in Kansas, wheat, though our base is 50% of all the acres, wheat makes up only 34% of the planted acres in Kansas. And that example plays out everywhere, okay? And here, if it's not irrigated, how much corn gets planted? Very, very, very small amount of acres. So again, region by region, this varies. But what I'm getting at is that this safety net that's supposed to protect you when prices go low or you have bad years is actually quite a bit, there's a lot of decoupling from what you're actually doing today because things have changed and irrigations come in and et cetera. So factors to consider as we look at stuff. So wouldn't it be great if we could do a mandatory base update? Sounds good, right? Look at Kansas, $286 million, okay, coming from the Senate Ag Committee, $286 million more for Kansas agriculture as a whole. Should we do that? Okay, show of hands, who thinks that seems like a pretty good idea? Okay, Texas people, Oklahoma people abstain. Okay, so out of my Kansas constituency, who thinks this is a good idea? Right? Feels like a good idea when I look at this slide. But unfortunately, it's the Desert Farmer meeting, and you would be mistaken if you thought that's a good idea for a lot of people in this room, because you would actually lose base in this area. Why would you lose base? Because of summer fallow acres.
okay? And things would actually go backwards. So the big thing is to dig deeper before you just see a soundbite and decide to amplify it on social media, okay? And some of those things, because there's real ramifications if you guys in this area would decide to promote base change. It's great, it's actually really good for me. I'm right there in this blue area by Harvey County, thank you. But I don't think I can advocate for that because a bunch of my farmers are impacted, okay? So be knowledgeable, okay, is what the long and short. And obviously, even again, so right there in Oklahoma, it's even better. I mean, it's also good, but it just depends on your county and where you're at, so. So because there's this decoupling, because we may be planting crops I don't even have base for, okay? So on my farm, probably 50-60% of my acres are corn, both irrigated and dry land. I have 55 acres of corn base on my farm, so very good safety net there. So I have to look to other ways to actually try and protect and stabilize my income and try and figure out, hey, what's gonna work here? What I did is I looked at our customers in this area. So let's go west of, let's see here, I don't know how far west I went. Everything would be west of Dodge, probably. Yeah, Dodge and west. I looked at customers and I looked at total base acres that they had. And then I went and calculated up as a percentage what they were. And so I had customers with a milo base range of 4 to 35% of their total base. Average was 26. Beans 0 to 5, 1. Corn 1% to 73% of their base. Average 26, so that 73 is quite a bit of an outlier. And then wheat 23 to 59, average of 47. Okay, a lot of irrigated farms that had a lot of irrigated corn base. Not traditional. Okay, this is not you if you're only dryland. So there's 2 or 3 dryland only farms, but not enough to move that number, what I would consider Kansas average or average for my area. But again, we look at it by region. So with that in mind, why is that? Why is it different? And as we talk with people, our customers, and we're trying to make predictions about the future. So when I worked with customers in 15, if they're my customers, I punched them in the gut and said, we might have to give up some extra money on this guaranteed wheat ARC money in 14 because this could go forever. We may never get to do this again, and you're not planting wheat anymore. And so we tried to update and be aggressive on updating to milo, corn, beans, and some of the crops that they were planting at the time, all right? And that, back then it was a lot of central Kansas farms. We've expanded a lot west here in the last 4 years. So that said, my farmers were what I would say as aggressive as anyone could be in getting their base to reflect what they were doing. Okay, but even my farm, even though I wanted to update, I didn't plant my first cornfield till 2012. Guess what? Nothing to update to. I didn't have any history. And so that's where a lot of people fall into it. And so one thing to look at, even if you were aggressive on this and you updated to, and it really reflects what you're doing, when you take on new ground, most people didn't update at all. And so when you take on new ground, you have to really look at that base because it may not have the safety net you thought it did. It may not have base acres, all right? Out this way, we're really short on base, and I know that if I was gonna sell ground, first thing I would do is make sure that I took the extra base that is on that and put it on and make sure I have full base on every acre I'm gonna continue to own, okay? So I'm sure someone in here has bought a farm and it says no base acres on it. You have no safety net unless you choose to buy it, okay? So anyway, just be aware as you take on ground, it's probably gonna be different than what you've been doing. So then we go to, okay, Justin, you're saying that if you don't have a safety net, you gotta pay attention to this. Well, how do you even look at this? Because I hear everyone saying I should buy PLC or get PLC, or everyone says I should buy ARC. And so thanks to K-State, there's great data out there. And so I can look at, and I went to Seward County, 2024 Milo, non-irrigated. We've got a price at $4.80. Don't know what that's gonna be. I'm buying 75% MPCI. I've got a farm APH of 81. It's their best field, right? That's a pretty high number for dry land. And then I look at and I see ARC expectations, I see SEO expectations, and say, what does it all mean? Well, what this says is ARC, because we're throwing out a bad year, right? Actually has a guarantee higher because we've hemorrhaged prices on our crop insurance and our futures prices. We're expecting prices even, okay? It says that my 86% guarantee with ARC is giving me a trigger. If we stay and would have a $5 marking your average price from harvest on, we would have a trigger of ARC at 60 bushel an acre. Doesn't matter what happens on your farm, but 60 bushel dryland milo in Seward County is not a bad number, right? And again, you'd say that's way too low. 3 years ago when I met people here for the first time, like, I don't know if we need to buy crop insurance anymore. We just have 40 years of 90 bushel milo. And I said, well, regression towards the mean may happen because you also have in your 10-year history 7 years that get thrown out because of YE. So maybe that'll happen again. It did, right? We've seen that it's happened now. And so now we're back to a 66, very good number. We have a trigger that when our revenue goes below $286 with the county expected, we start to trigger this ARC money, all right? SCO has a little bit lower APH because we don't get to throw out that high out of the last, or the low out of the last 5 years. Triggers at 51, okay? The thing to remember is you have to look at that underlying base. So if I'm planting milo on a farm that has no milo base, do I get an ARC payment? It doesn't matter. I do not get any payments unless I have those base acres on that farm number. And so I have to make sure that I am going to qualify for that by having that base. All right? I may be planting it, and then what might my base be? Is my base usually full acres? I'm planting 160 acres of milo on this farm on this quarter. Do I have 160 acres of milo base ever? I haven't seen those farms yet. So even when I'm doing that, I don't have full base usually. Usually it's something less, and it's split with wheat or maybe something else, or I may have no base. So long and short is I look at these and say, well, hey, ARC looks really good, and it does, unless I have no base there, or unless I have one base acre, right? I have one base acre on this 160 acres. Great, I get $26 when we have a bad crop, okay? And so there's some other tools with SCO and ECO that hopefully your agent has brought to your attention. And if not, when you get through this, your goal is to go back and say, hey, maybe I should just find out about this, see what your agent says about SCO and ECO, because it might have a role in, again, stabilizing my income, increasing long-term ROI. So we'll take a look at that. So we'll go back to that example here in Seward County, 160 planted acres. This is my wheat base, okay? And so I matched that up to the average for this area, right? So this is an average farm, 47 acres of wheat base. Again, the base is short, which would also be average. So if I trigger an ARC payment, everything's bad. We have 50 bushel, $4 milo. I trigger a payment. And I trigger the max payment, I get $26.71. $1,200 coming to support my milo crop that has probably failed if I'm just gonna have the average year with the county. SCO looks at planted acres. SCO looks at harvest price, and we end up with a guarantee of $43 an acre, $68.43. We did pay $6, it did cost us money, but our net is $58.83 less that. Okay, and so that safety net that we're adding on seems to be a little bit stronger than the small base we have. This plays out over and over across your county and your crops. So this is an Oklahoma, Colorado, you name it thing. There's places where ARC is clearly better, right? Because there's also farms where I'm going to plant 20 acres, or I'm going to plant 160 acres of milo, but I have 500 acres of milo base. Do I want to give up 500 times $26 for this little tiny SCO type of thing? No. So it really comes down to field by field, crop by crop, year by year, ARC or PLC, does SCO pay, all right? And so that's the thing that you need to learn to examine and work through. So one example, clearly we're average intelligence. We choose an example that's gonna support what buying SCO, because I sell SCO, right? Give us that credit, but I'll show you the other way here. So here's a Kansas Gray County wheat example, all right? Or we'll go through a few here. On Gray County wheat, notice that the price on the wheat has not come up yet. Okay, that's the ARC price expected. And so that wheat guarantee is still lagging, even though the expected yield is the same. Crop insurance price set at $7.34, our ARC guarantee is $6. And so there's this lag that says that if I buy SCO, I can get a full payment, get all of my $65 an acre or whatever it might be against the possible payment of $21 coming from the actual ARC base there. okay? So again, the thing to see is a few things about SEO. What happens to our likeliness to trigger an ARC payment as prices rally and go up? Again, audience participation, and I've shown you that you can't see it though, okay? As prices rally and go up, so we have, 2 years ago, we had the wheat year, right, where you guys did not pass go, right? We did not finish. Crop insurance was determining your income, and we set a price, or we bought crop insurance 2 years ago at $7.88. We all failed, and then what was the harvest price? Does anyone remember? It was really good. It was $10.88. Okay, so you got paid 50% more on every bushel loss than what you paid for on the crop insurance, meaning your crop insurance guarantee increased by 50%. Okay, guess what? Your SEO does too. So when we go from $7 wheat to $9 wheat, our SEO guarantee went up. And so our farmers who, let's say, with some average APHs, were ended up with a $40 SEO guarantee, ended up collecting $60 an acre. Okay, what about ARC? Did everyone collect an ARC payment? Should have had that graph. I made a mistake there. The only people in Kansas that collected ARC payments from in October, right, this year, was this line of counties along the very southern border of Kansas. No one else. The entire state missed out. We had less than half a crop, but because of the ARC guarantee was at such a discount to actual prices, and the marking your average price was still high because we didn't have wheat, right? Kansas wheat rallies when we don't have wheat. We do actually have some impact there. We didn't get any money. And so SEO people collected $60 an acre. ARC people did not, and didn't even get anything. So there's a lot of different scenarios to consider as you look at these, okay? So Gray County, if I'm not planting wheat on that farm number, again, this is county by county, crop by crop, what am I gonna do? I should put it into ARC last year, maybe this year, or likely this year. I hope this year. I hope prices don't go down, we get PLC payments, because it doesn't matter whether I plant it, I'm gonna get this money if the county triggers. And again, PLC only triggers with very low prices, right? They seem very low for the last 3 years. Are they very low now compared to where we're at, right? Anyone remember what the PLC trigger is for this year? It's $5.50 wheat, okay? What are the local elevators offering for a forward contract wheat price? $6, $6.15, $6.20, okay? Maybe lower. So we're not away from that anymore. But again, today, it still looks like, hey, I do this. SEO, you didn't buy it, but you didn't have any acres planted, so there's nothing to get there, okay? But if I just plant half of this field, or I just plant half of 1/2 of these acres, so I've got my summer fallow rotation there, $1,000 versus $29.42 net, okay? So there's some safety net with SEO that still is in play, okay? Will this be the same example next year? It will not be, because guess what? We're finally going to stick some higher prices into our wheat ARC guarantee, and our guarantee price, instead of being $5.50, hopefully is gonna move towards $6 or higher. And so next year, I can't tell everyone that you should probably buy SEO, all things considered, okay? This year, as we met with people, we had to say, hey, for the last few years, because of these price issues that we have, the crop insurance is so much higher and so much better, you should buy SEO because it's gonna pay the full amount before ARC even thinks about it. That's not true. Now, the prices are even. ARC has some better things to throw at bad years, and you can get paid more or paid equally and faster with ARC, and you guys don't have to write a check for it. Okay, so again, year by year. So I say, okay, Justin, you cherry pick some years because you're, again, average intelligence. Obviously, you're going to try and convince us of something. But I thought, well, let's go and look at 20 years of data. So this is 20 years of Finney County irrigated corn data, all right? And here is the expected yields. Here is the county realized yields. And when I look at SEO, again, that goes from my crop insurance up to 86%, triggered by the county. I would have found out that I would have had payments in, again, I'm just going back 10 years. You can go back and see there's a whole bunch more there we're not considering, but 13 full payment, 14 full payment, 22 full payment. So 3 years. You're saying this program that you're buying, that you're selling to your customers is only paying 3 years out of 10? Who would want to do that? Government subsidies say you would want to do that because you paid let's see here. Oh, you paid $7.60 per acre for that SCO policy, and it is kicking out $293 in premium. Seems like an okay deal to keep doing over and over, okay? I encourage you to go talk to your agent, ask for the data from your county and crops you're planting. The average that I've found when I look at this over the last 10 years, irrigated, dryland, you name it, is anywhere from 1.5 to 2.5 to 1 on farmer paid premium because of the subsidy. Seems like a decent business investment, okay? Again, loss ratio 3.86 to 1. What else are you doing that's giving you that type of loss ratio, okay? Is it always because we have a bad year and can't raise irrigated corn in Finney County? No, only one year was really about production, and that was 22. Every other year is what? What happens to corn at harvest? Price goes down, triggers a payment, okay? I did not include 23 in there because it's not official yet. But when we look at data from our customers and from when we talk to the companies we write insurance for and look at all of the data that's come in and claims they've paid, it looks like we had an average year, okay? So if we expected 205, we probably averaged 205. Does that mean no payments? Nope, that means we are getting payments because what happened to the price last year? It fell by 17%, okay? And SCO triggers at 14%. So because of that, I would predict in telling customers we're gonna get full ECO payments and we're probably gonna get part of our SCO back, all right? So even last year, when a lot of people we had the year that we've never seen, where we had more rain and we had an average year somehow, we still expect ECO payments that are probably gonna give us a 3-to-1 return on last year. So something to consider there. So there's a lot, okay? When we talk to people, it's not like we just say, here it is, look at this, and we go on. There's a lot to look at. There's a lot of individual decisions that you need to make. And one is, you need to have a plan of where you're gonna plant stuff. The second thing is you need to know what your base acres are, okay? You need to know your APHs, you know what the county ARC guarantees are and how they trigger. You need to have some comfort level of where prices, what range you might feel is comfortable on expected prices. And then from that, you can start to see, is this something I want to do? All right? That said, when you consider base and prices, I'm sure everyone in here has a place for SCO. Even on, again, I used an irrigated example to show you, when I think of stability, I think of my irrigated crops, right? It's the most guaranteed return. Guess what? It throws higher returns and not higher returns, it throws more consistent money than our dryland crops. Because the any price dip, when you have shallow loss coverage and then any type of price dip that we historically have, throws us into payments, okay? So, summary, ARC guarantee is relative to SCO. ARC is improving, and on the row crop, it's different, okay? It used to be, hey, we know that we're buying SCO. This year, it is, hey, we're only buying SCO in this area on maybe 10 to 20% of their farm numbers, okay? It's because they have no base or low base. But most places, they have enough base on milo, maybe dryland corn, it doesn't pay. So it is a very specific decision. ERP was pulled forward, as Chalk mentioned. I encourage you to look at that. If there is any of those categories you can check, get the 860 form filled out. And then finally, that. So when ECO came out, you're going through ECO, so I should shut up. This is, as Chalk talks, just remember this. ECO has a 1.25 to 1 loss ratio on any crop, any county in Kansas that we ran it on. I would argue that it'd be the same in your state as well because of the way the structure of cost works. So something to consider there. SCO is more like 2.5 to 1. All right, so if I can tell you 2.5 to 1, I don't know what to do. That's something that you should really consider adding to your portfolio. Again, I'm saying stabilize. I'm trying to tell you to stabilize ROI and the highs and lows. But if this is consistent and continues, am I stabilizing ROI? No, I'm boosting ROI. All right, so something to consider there. All right, Chalk's going to take the next section here.
Thank you. So just went through SCO and how that ties into ARC and PLC, and there's tons of considerations there. Every year that changes. Your planting intentions, your planting acres will change by farm number. And you need to look at that ARC and PLC guarantee by farm number 2. And so there's a lot to go into that. ECO, enhanced coverage option, SCO goes from 86% down to your coverage level. ECO goes from 95% down to 86. So it's very shallow coverage, top end coverage on top of whatever your SCO is. The nice thing about ECO is there's no coupling with the ARC or PLC program. So it doesn't matter what you enroll in, ARC or PLC. If you want to purchase ECO, you can on any farm number, and it doesn't matter if it's an ARC. So
It
the
doesn't
beauty.
affect landowners either, right? So that's one of the considerations with SCO. If you elect PLC and your landowners are at the coffee shop, they hear all their neighbors got this ARC money, they're not gonna get that. So one thing to consider is make sure your SCO is so good, or they're buying it too, so that they're protected, or else you might write them a check. You're still ahead, but you might write them a check for the ARC payment they should have got, even though you elected something else, so.
Yep. So ECO, looking at Finney County irrigated corn here, kind of our example, 200 bushel farm APH. Our ARC guarantee there, or ARC trigger, or ARC yield is 198. SCO has a 205, so a hair better SCO yield there for Finney County irrigated corn. You can see down here, ECO starts to trigger a payment at 195 bushel if our price stays the same at $5. The coverage there is $90 an acre. And so top end, very shallow loss triggers with ECO. So even on irrigated corn, irrigation across the state, is ECO likely to trigger a payment? And how likely is it to trigger a payment? So looking at this graph, you can really read it if you're in the front row, not even. But over here, we're in Seward County right here, 78% of the time ECO will trigger a payment, looking at historical data.
So to clarify, that is from K-State. You can go to Ag Manager website, you can find it, and that is the last 20 years. They are saying that 7.5 out of 10 years, ECO is paying, okay? So blue is all 70s, yeah,
Yep.
high 60s and 70s. Red is 70s. Yeah, these are higher. This is higher. All the blue is higher than 70% chance of collecting. Red is 70, and all those yellows that who would ever buy it there are down at 60% or so. So 6 out of 10 years, it's paying something back to you.
Yep.
Okay.
There's only 2 counties in the entire state for irrigated corn that won't trigger a payment more than half the time. And it's just below half. It's 48% of the time. So even on our irrigated crops where we feel like we are very stable with our production, we are. And the beauty of it is that it pulls into price. And when we're stable with our production, we're not going to blow the top end out of it like we can with our dry land. Then it just takes a little bit of a price drop to be able to start to trigger a payment. So looking at Finney County corn, I'm using last year's example now. Our 488 harvest price, we had a 591 projected price. So we had that 17% price drop last year in Finney County. Our farm APH was 210. We bought an 80% level, which doesn't matter for ECO. However, our expected county yield was 205. Let's say we had a little above average yield in Finney County at 213. We came in, our final county yield comes in at 213, a hair bit above average. However, because of this 17% price drop, our ECO revenue last year was $112. That's what we were guaranteeing. With an average yield, because of that price fall, we're collecting over $100 an acre from ECO. And so being able to protect against a price drop like that is incredibly valuable for you as well. So 95% coverage there with ECO. Looking at the same chart and looking at ECO and how it pays out. 20 years of data here, we're looking at the last 10. And over the last 10 years, Finney County irrigated corn, 6 out of the last 10 years, we have had a payment on irrigated corn. If you add up, or if you look back here, 2013 was a full payment of ECO, 2014 was a full payment of ECO, and that reason is because of a price drop. Then we had shallow payments in 16, 17, and 18, small percentages there, however they add up to another full payment, and then in 22, we had another full payment of ECO. So 4 full payments over the last 10 years of Finney County irrigated corn. Long-term loss ratio there, 1.25 to 1. Over the last 10 years, it's been trending 1.33 to 1 on farmer pay premium. Now, that being said, ECO, shallow loss coverage, like I talked earlier, when you seed off your risk, you're paying a premium for it, right? Especially shallow losses. ECO is not a free program. So over the last 10 years, you've paid over $200 an acre, so $25 an acre in premium. It's pricey. You're spending about a third of whatever your coverage is. It's about a 30% rate there, 25 to 30% rate for ECO. However, you've gotten back over the last 10 years $360. So ECO can be an option to look at there, and it's something that we, no matter what the crop is, no matter what the practice is, no matter what the county is that we've evaluated, it has shown these same numbers. And so it's something to be evaluating for your portfolio. One consideration there, ECO and SCO doesn't get paid out until July of the following year. And so part of this is that we have to look at how much capital you have, and interest at 8 or 9% is real, right? So your operating notes are a real interest rate. And we need to take that in consideration and see how willing you are to let that carry out for another 6 months before it gets paid out. So those are considerations that we look at there. Moving on to just some more generic crop insurance information that I want to make sure that you guys take home and make sure that you go to your agent and have these options on there. So these are crop insurance options on your policy: YA yield adjustment, YE yield exclusion, yield cup, trend adjustment, quality loss. All these are yield helpers. And so if we have an average APH out there on non-irrigated corn, maybe we're averaging about 75 bushel an acre. Great, fantastic. However, you throw on all these options and you can get your guarantee up to that 85, 90 range. So make sure that when you go back and look at your crop insurance policy, you're evaluating decisions for this year, that all of these options are on there. They don't cost anything unless they help you. And when they help you, you're paying 5 to 1 to 15 to 1 in premium. And so it's a very small amount of premium that you pay for the added benefits of all these options. So make sure those are on your policy, and if they aren't, then ask why they aren't, and evaluate why they want to be. So holler at us, we can get you these options, we can tell them to you after the meeting. Rainfall index policies. Another thing that you need to be aware of, if you have any feed, if you have any grazing cattle, anything along those lines, and you can use a rainfall index policy, whether that's PRF or annual forage, to cover drops in precipitation. So you can insure up to 90